Thank you for coming. Thank you, everybody who's online there. Yeah, I'll go over a little bit about my background. Allison sort of described it, but I started as an SEC lawyer with the Securities and Exchange Commission about 30 plus years ago. I worked with some of the early cell companies back then that were just beginning to form networks of cell companies that ultimately resulted in the type of infrastructure that we have today. My clients today are biotech companies and semiconductor companies and other technology companies, some public and some private. I also have a few clients that are venture funds that invest in local companies, national companies. And the emphasis of the discussion today is really on taking the company through the early processes of negotiation. I've represented maybe 100 plus successful startup companies that have either got sold or went public. So again, looking at this from the standpoint of the startup company and trying to put it in some context for the type of negotiations that you all may be doing now or may in the future be doing very soon. So when you're representing the smaller company, and this is sort of looking at you doing a deal with a much larger company, the first aspect of it is pre-deal preparation. So it's really important for the smaller company to really understand much more about the larger company so that it can go into the negotiations with its eyes kind of wide open. So part of that preparation is just finding out what you can on Google, actually having those initial discussions with them to try to really flesh out what they're interested in, what you're interested in, et cetera. One of the key issues that will probably come up if you have patents is that the bigger company is going to want to drill pretty far into what have you done, what have you filed, and sort of freedom to operate kind of issues, because ultimately they may want to incorporate that technology into their technology. So they would have a real concern about potential infringement issues and other issues. So it's good, as one of those preliminary checks on the system to just really identify if you think you've got some issues in the patent portfolio. And I think, again, from your standpoint, it's really to take a step back, and we'll go into this more throughout the presentation, but really to take a step back and try to identify the key strategic issues for you. Again, from the big company's perspective, this is one of many deals that it's doing. You may or may not have a key technology that it needs. It may be looking or assessing this against 5 or 6 other technologies, which it believes are similar. So from your standpoint, it's really important to identify the key strategy things that you want. From their standpoint, again, it's important to understand that they're looking at this as maybe a specialized technology that could be useful to them. It may be useful to build into existing products that they have, which would give them revenue enhancement opportunities. And it's also important because many companies today just don't devote as much to research and development as they previously did. So from their standpoint, it may allow them to leverage their resources by having those discussions with you and ultimately potentially getting into a deal with you. So just as 3 principles to follow, and again, in your classes, you may or may not sort of talk about the hierarchy of needs. That's kind of very elegant from our standpoint. We're much more basic in terms of the practicality of negotiations. And I sort of boil it down to these 3 things. First, determine what you need today. So as you go through the lifespan of a startup, those needs change. The first one may be just getting on the map, just trying to get a deal done for different reasons. One reason may be so that you can go to a funder and say to them, yeah, I do have an early adopter client. This is what we're doing for them, and we are generating some revenues. Again, sort of going back to what I talked about before, determine what your counterparty is looking for. And that's really, in my view, the most important part of the negotiation you'll ultimately have, is to really understand why they need it. Also to maybe figure out, are you looking at 3 or 4 other companies, or is my company really the one that you're focused on? Finally, to think strategically about the short-term consequences and the long-term consequences of the deal that you're going to enter into. So I looked at, or sort of set out in the slides, a couple of these key negotiations that you'll have over time. The first is, sort of the university license. It's not necessarily a university license. It could be a third-party license, which gives you part or all of the core technology that you're going to need. So the primary focus in this type of negotiation from the startup standpoint is to determine what are the license and sub-license rights that I need to basically move my company forward. So, in most university licenses, that's pretty cut and dry. It's usually fairly broad-based as to what you get. There may be a question as to whether you get exclusivity, meaning you're the only party that can actually use it, or whether you get non-exclusive rights. And the difference in that is, in many instances, how much equity you give up or what royalties you give up to get those rights. So going to the second point on equity and royalties and non-negotiable positions. So from this standpoint, again, looking at it from the short term and the long term, on equity and royalties, the real issue for you is, if I pay the university or the third party what they want, will I still have a viable company? We did a deal years ago with one university where they wanted sort of 20% of gross revenues to license the technology. So what the entrepreneur did is they kind of went back to a potential funder in the company and said, if I do this, and I agree to this 20% royalty, essentially, would you still fund me? And the funder came back and said, no, we wouldn't fund that company, because when we run you through your business model, you'll never be profitable if you enter into this license. So we went back to the university and kind of said, like, look, we can't do this deal. Here's why. This is what our funder actually told us. And at the end of the day, I think we ended up with about a 5% royalty that was paid. The university just, in that instance, fundamentally didn't understand kind of what it was going to take this to a broader audience, to actually have customers and so on. Also, when you do these kind of negotiations, it's kind of important to look at what's non-negotiable. There'll be, so the license itself could be a 20-page document. There may be 15 pages of it. You can't negotiate. Some of those things might be indemnity provisions. Some of them could be particular kinds of sub-license rights or what have you. But in that, it's important to kind of assess early on, either with your team, with your lawyers or whatever, what is it here that we can negotiate? And what are the things that we shouldn't even waste our time with? And that actually applies both to this kind of license and other kind of negotiations that you'll have. Some of the other terms that you would want in a university license would be options on new developments. And one of the longer term aspects is what happens on a sale of the company. So again, you could be building a startup for 3 different, let's say, scenarios. One scenario is we want to build it and we want to sell it to a third party. I mean, that's most of my clients, and that's mostly what they want to do. The second would be we want to build it and we want to try to take it public. We really see a much longer tail on this thing. And the final is, we want to build it and I want to run it for the next 30 years. Well, that's not that common anymore, but I have a client today that's exactly what they did. He was a professor emeritus from CMU. He built a really differentiated technology. I started working with them, I'd say, almost 20 years ago. He's now retired. He's turned it over to the next group of entrepreneurs, and they're still running it. And it's a profitable company. The people enjoy working there. And, they have that kind of thing. That's not most of my clients. That's probably 10%. But the point is, you have to really understand with these fundamental contracts that you have with the company, what happens on a sale. So you really wouldn't want, let's say in the case of a third party, their ability to say, you can't sell this company. you really want to be thinking about at the beginning of the day, these really important contracts, what happens when you get to that potential exit event. The second area that I wanted to take a look at is this key hires or advisors to the company. So this is, again, something that you will confront very early in the company as you move from, let's say, the 2 or 3 founders, and now you got to bring some other people under the tent to make the company successful. So the first question is, going back to the basics, what do I need to give up to get this person? And, sort of like, the components would be salary, equity, and, potentially severance or something like that. And the key sort of takeaway on these early negotiations with parties is that, many people will ask for everything to be upfront, and essentially, I'm leaving this good job and I want to be able to come work for your company, but I need the type of salary, I need this level of equity. And again, I want it all up front because I just, I don't want to take the risk that you change your mind on me. But the important thing for a startup is this may not be the right person, or it may not be the person who takes you as far as you need to go. So you always have to consider the fact that it may not work out with this particular person. We had a recent issue with severance in a venture funded company where the CEO has a good position today. The venture funder is, the venture capitalist is putting money into the company. And the founder said, well, geez, I know I'm going to give up some control here. And I want to at least get 6 months of severance if you change your mind on me. So we had discussions with him about, why he thought he needed that level of compensation and so on. And at the end of the day, we kind of reached this compromise, and it worked like this. Look, if we determine in short order within the first year, you weren't the right guy and you determined we probably weren't the right funder for you, we got to go get someone else, we'll pay you a couple months of severance. The longer you go out, the more severance we'll actually pay you, because at a certain point, we kind of understand your concern. But early on, we're taking risks too. So we don't want to be in a position where, again, we're giving you everything up front and we find out that we made a mistake about you. Equity works very similarly. And in these type of deals, you can do various things to sort of tie the equity to performance. So the way people many times look at equity is they just look at it and say, well, I'm giving up 4% to get this guy, this person, and they'll earn it over the next 4 years. But what may be a better way to do it in many instances is to align it against performance metrics, which is completely legal, and in many cases works better. Or you can have a combination of sort of a time and performance metrics sort of line up. So again, those are the considerations, some of the considerations when you first look at hiring somebody to bring them on board. Advisors are very similar, where many advisors might bring a name to the table, and they might say, well, in exchange for that, I want 1%, and I want it all up front. Again, what you find in many instances is the advisor doesn't give you what you're really looking for. They really just don't give you that much time. So you may determine, nice guy, person, but I need to go in a different direction. So you really want your contracts with those type of people to be, which is in your discretion to determine whether or not you want to continue to use them. If you don't continue to use them, some of that equity goes back. And so again, the key considerations in this type of early negotiation is just to look at, there's everything is not black and white. And there are many type of positions you can sort of, if you have conversations with the other party, figure out where you need to go. This first important customer, it's a lot like the license kind of discussion. So after I sort of sent this in, I thought I kind of want to take this in a different direction. So I'm going to kind of ignore this slide and just talk about a deal that I did years ago. It was probably 15 years ago now, where I represented a pharmacy software company. They basically sold their software to independent pharmacies, so pharmacies that had, let's say, between 1 and 5 branches. The software was pretty basic back then. It just allowed each one to run it within their individual drugstore. And then at the end of the day, they accumulated the data by more or less sending it on to, let's say a manager who then accumulated it across the chain itself. So that's what they were doing. They had maybe, I don't know, 500 customers, something like that. Maybe 1,000 drugstores that they were doing this work for. So not a bad sized company, but certainly not, a major company. They began discussions with a public company that had a small division that did the same kind of software for mid-size companies. So these are mid-size pharmacies. So these would be pharmacy chains that, let's say, had between 5 and 25 drugstores. And so the initial discussions were kind of, what can we do together? How can we actually make 1 + 1 = 3? And initially it was sort of the big company saying, well, maybe we should just buy you and we'll just amalgamate you into us. And my client, who was a really good entrepreneur, just kind of looked at that and said, well, they've kind of made a mess of what they've got thus far. So they're not making money on their side. They are much bigger than us, but they're not making money. And so as they had more and more discussions, what sort of came forward was, well, the small company, they're much better at actually developing new technologies. And the goal is to now maybe go after bigger pharmacies. So we have the small part, you have the mid-sized part. Maybe we should go after larger pharmacies together. And maybe the way we should do that is we, the small company, should buy you, the big company. Now, how could we actually do that? We didn't have the cash to be able to do that kind of transaction. So as they talked about it more, again, we found out, well, the big company, they actually lose money. They kind of want to get this off their balance sheet anyways. They don't mind putting in more equity or getting equity in exchange for maybe selling this company to us. So we just did a deal where we picked up the company. They took equity in the smaller company. They agreed to put money into the smaller company, but we gave them an option if we got to the point where the company was going to be sold, that they would have the first right to buy the company back, essentially. And so with that in mind, we went out and the company built the new software. They ended up being able to sell it to some very big chains. One was CVS. That was a bigger contract than either of the two had really ever entered into. And when that contract happened, we were then acquired back by the bigger company. So what started off as sort of a, kind of what can we do together with the view towards big company acquiring small company, ultimately became something different when the parties really explored, well, what are we actually trying to achieve here? And what they were really trying to achieve was, we know that there's a market need for the type of software that would allow this to be across much larger organizations and be tied in through the internet, versus the kind of solutions they had today, which were just these one-off stores where the internet was kind of supplemental to what they needed. So that's ultimately what they did. They built that. We sold back to the bigger company. And within a year, the bigger company, which was a public company, they were sold to someone else. I think McKesson, I don't remember exactly now. But so it worked out for everybody in that particular negotiation. But that's really because people were focusing strategically on what they wanted to do and listening to what the other side, had to say. Sure.
Is there a rule of thumb for how much equity to reserve initially for potential new hires in the future?
Well, it depends on, the question, did you guys hear it? Okay. The question was, how much equity do you give for new hires? And again, that's kind of all over the board. It really depends on what's the position that you want to fill, how early it is in the company. So for early stage CEOs who are they're coming in after the company's not the founder, but they're coming in later, it's maybe in the 10 to 15% range. For somebody who's a killer VP of sales, it could be 5% or 10%. Usually it's closer to 5. For engineers, it's usually a couple percent. Again, we're talking like pretty early on in the company, and everybody is diluted by the additional equity issuances that happen as you go forward. So again, looking at this other final topic, I think, which is raising capital. The first question is, how much capital do I need to move the business to the next level, and is this the right partner? So again, I kind of know I've represented many startups over many years, and typically when you finally get an offer to put money into the company, you pretty much want to take that offer if you can. Often though, and it depends on the market, what's going on in the markets generally, maybe there's more than one funder that's possible. And so what you really want to be thinking again is sort of strategically about raising the capital, not taking more than you need. Well, you take slightly more than you need, but not taking too much such that you're just diluted down to nothing at the time of the first deal. But what I'm really focusing more on is the right partner in those kind of transactions, because it's not just about the equity allocation. Early on, when I did this, 30 years ago when we were doing the first venture deals, the sole focus was sort of, how much capital do they have? And so no one really looked beyond the issue of, well, who's the funder and is this the right partner? But kind of in retrospect, one of the things that matters the most is this the right partner for your company? Is this a win-win kind of venture capital investor? Because in the longer run, you're going to have to look at, hey, how you doing? You're going to have to look at, what is the economic upside and the operational control that you're going to give up to get that money in. And if you're working with a venture capital partner that is one that works constructively with startups, then they're going to work through those issues with you. On the whole, most venture capitalists don't want to actually control your company per se. That's why they're investing in you. They're hoping that the management team that you've put together will carry you. But in many instances, of course, there have to be changes to the management team itself. One fund that I worked with kind of extensively over the years, always on the other side, when I was representing the issuers, and they had other lawyers representing them as the funder, was Edison Funds, which sat in New Jersey. And one of the things that they always brought to the table was they had a great network of potential advisors and directors who had relevant knowledge in the domain. And the other thing was they had the capital to sort of take you to the next level as the company developed. So, they were more than just the money that came in. They also offered these other benefits. The longer term consequences of the deal are that, that's the partner. They're probably going to have the ability to decide in some respects when you sell the company, whether they're prepared to sell at that point, because the rights that they get in their securities will probably give them either a veto power or the power to sort of pull the transaction forward to get it done. So again, it's very important as you look at that kind of negotiation to be thinking about things beyond just the pure economics. And I would say in most negotiations, that's true. Most people focus on one thing, which is just a dollar amount. It is the most important aspect in many, many negotiations, but there are many other things to be considered. And one is the quality of the partner that you have. So again, to kind of summarize, when you're representing, for me, I'm representing the startup, and from your standpoint, you're founder of a startup company, you want to be really thinking strategically about those early deals and the people that you bring on early, because it's going to have a profound impact as you go forward. As the company gets bigger and bigger, some of those deals will matter a lot less. And even from the question that we had earlier, you'll kind of reach a point where you know exactly how much equity somebody should be getting, and you'll have kind of laid out the parameters of, okay, how did they get it and how do we align interests properly. But early on, there can be a lot of one-off sort of things that happen. And you just want to be thinking down the road and making sure that you haven't given away the company early in exchange for just getting something in that you thought that was necessary at that point in time. So with that, I'll kind of bring this to a close and happy to answer any questions or whatever you got. I had one first. My question was, what do most of you do? Are you with startups? Or is it just more, I don't know, general interest? Or I'm just kind of questioning whether, what I should have asked you that before I started, but just wondering. Yeah. Related to. Yeah. Oh, okay. Okay. Yeah. So did you license out of the university then, or? Oh, I see. Well, they're actually extremely nice to work with on licenses. I mean, I have to say, they have a very good department that does it, and they're very reasonable throughout the process. Even when you have issues going forward with the licensing, they get it, I think, and they do try to work with people in a very fair way. So good.
Question? Sure, I can show that. So when you speak about partners and things, so you said when initially start, maybe not being another partner for the things like the second field or how they feel or things like that as you're expanding, you need more friends and rights and you bring in another big partner for the expertise, right? So in few cases, you already work with these people for X and in few cases it's more like you just start to work, right? So, and at that point, you are giving up. Will you also, like, what are the drawbacks of giving or not giving voting rights?
Giving what?
Voting rights?
Oh, you mean to an investor or to? Okay. Well, there's kind of two aspects that what you're asking, I think. The one aspect is what kind of equity would you give them? Because you would probably give them what we call restricted stock to make sure that, again, they sort of earn that over time. The restricted stock could be non-voting stock. So you could, as a founder, the main founder, if you will, try to keep that voting control altogether. Or you can do that in different ways where they might give you back. It's called a proxy that allows you to vote their shares on whatever those things are. But yeah, those are worth thinking about because, again, you may have to make decisions early. Some of them could require stockholder approval. And in those instances, you probably would want to maintain that control.
But from an investment perspective, right, trying to raise capital, what is like, are there any drawbacks, especially when you go down to the capital, like you see, hey, you have 3 founders and then one of them doesn't have voting rights?
I don't think the funder would typically care. The funder is concerned with its own kind of voting rights, which usually are like either veto rights over different things or things that would require specific voting of their preferred stock. Let's say they would typically take preferred stock. So I don't think in most instances that would bother them. They might be more concerned about the equity split and whether the equity split reflects who's doing what and whether you've got people aligned enough. Yeah. Yeah.
Advisory shares and how are they different from the general shares?
The advisor shares. I don't know that they're necessarily different. It sort of goes to the question that she just raised, which is you might want to say to them, I'm not going to give you a voting right. The main thing with the advisor shares is to, again, the advisor contract is usually much more one-sided in your favor that allows you kind of at any time to say, this isn't working out. This is what you've earned. This part goes back to the company. Because again, the biggest issue we see with advisors at times is that they lose interest. They're just not available. And the name alone is not worth the equity. Most of those, to the earlier question that Allison had, it's in the range of 0.25% to 0.5%. It could be more early, it could be 1%, but again, earned over time. Shares usually same common stock, just the basic stock that all the founders would have.
So if I'm not satisfied with one of the advisors, then I tell them that, okay, it's not working out, and the company has to buy back from me.
You don't really have to buy it back. There'll be a certain amount that they've earned that they get to keep. And then the remainder will just be forfeited back to the company. So it's more like an option, but it can be in the form of restricted stock so that, that has a better tax effect. But yes, you could have the ability to buy it back. That's usually not something we put into an advisor's agreement, but you could. Yeah, so otherwise it's what they earned. Yeah. Yeah. Mhm. Yeah.
And you're giving up stocks between your co-founders, like the equity share. Does it make more sense to distribute it according to the contributions you're making now or the contributions you're going to make in the future?
Well, that's a great point. That you want to actually factor both in, right? You could make it performance based in some respect. So it says we contemplate that this is what you will be doing, and if the person ends up not doing it, then they don't get it. But both are worthwhile considerations. And you could say, when this happens, you will then get another grant. So the only difference between those, I don't want to make it too complicated, is it could have a different value when they get the second grant. But what you're saying is actually makes a lot of sense. It's probably would be 2 grants, which is today I'm giving you this. If in a year from now you actually do join full time and you do these things, at that point in time, you get a subsequent grant equal to this.
It kind of has to be the middle of the two.
Sorry.
It kind of has to be the middle of the two, right?
Yeah.
Depending on contributions they're making now and you can possibly make in the future.
Yeah, I mean, again, if you're sort of talking about contributions in terms of the time, the amount of time they're putting into the business, it's one thing. If you're saying it's against certain deliverables, then you could make them align against the deliverables. Yeah, and early on, the nice thing early on is the company, from a tax standpoint, doesn't have any value. So your ability to use equity is really easy. It becomes harder after you take an outside investment, and then it has more of a defined value. So when you give equity, that could have a tax effect. Yeah. Okay, well, thank you for coming. If you have any follow-up questions, just email me or whatever. I'm happy to answer them.